Welcome to Yahoo Finance. I'm Diane King Hall along with Jared Blickery. Let's get you right up to speed on the market action. We're at the beginning of a new trading week and you've got some mixed market action today. You've got the Dow under some pressure, but off the lows of this session. You really had some moves with regard to yields, originally putting some pressure on the market. The S&P 500 on the plus side now had been under some pressure, up by 28 points there, up a little more than 0.5%. The Nasdaq has been the standout all session. You have that tech play in action again today. Nasdaq rallying a couple hundred points at the moment, up 1.5%. Again, looking at this play, reflection of the Nvidia play, but I don't want to get too far in the weeds. I want to get right over to Jared, who's at the Wi-Fi. Jared, what are you watching in the markets now?
Well, I am watching Nvidia. We'll get to that in a minute, but let's just marvel at the market action here. The Dow is in red while the Nasdaq is up 1.5%. This really reminds me of the price action from January through May of this year. That was when the mega caps were soaring. Check out this price action. XLK, that's tech. XLY, that houses Amazon, that's consumer discretionary. XLC, that's communication services. Those are our leaders today. And despite the fact that we have the 10-year yield at the highest level since 2007 or thereabouts, just an incredible surge higher. This is kind of a head scratcher. We're going to be talking about this in the minutes to come here. Just want to show you what's happening with the US dollar. That's just off marginally, but that comes after a 5-week consecutive rise there. So we're going to be talking about that. Let's take a peek inside the Nasdaq before we move on here. Here's the Nasdaq 100. Talked about those mega caps. Yes, Nvidia up 7%. Lots to talk about there, as well as Tesla up 7, Meta 2, Microsoft 1, and the rest under 1% there, Diane.
All right, that's some good stuff right there. We're certainly keeping a watch on this tech sector today, and of course, Nvidia as well, deeply in focus. All right, good stuff, Jared. All right, so the final full week of August set to bring investors a major market event. The Jackson Hole Economic Symposium will kick off on Thursday with Fed Chair Jerome Powell's speech Friday morning serving as the main highlight. Joining us now to discuss the Fed's current goals and what could come from Jackson Hole is Ross Mayfield, Baird Investment Strategy Analyst. Ross, thanks so much for joining us today. Let's get right into this and kind of paint a picture about what expectations are and what you're expecting from Jackson Hole this week.
Sure. So I think the Fed's July minutes gave us a clear picture into what they're thinking and what they're going to be talking about at Jackson Hole. That is still, in their mind, upside risk to inflation and the higher for longer mantra regarding rates. I think they're going to view, while the economy has been good, view risk still skewed to the downside as they continue to tighten those policy levers. But it's going to be inflation, risk to the upside, and higher for longer. And I think that while Chair Powell may ease off the hawkish rhetoric a bit because financial conditions have tightened over the last few weeks, I don't think they're going to step away from that party line anytime soon.
Ross, we hear the words higher for longer quite a bit here. How high is higher and how long is longer? Because we conceivably, with oil racing higher, we could see a reacceleration of inflation to the upside, which the Fed would be forced to contend with. Even if that doesn't happen, there's still echoes of the 70s. We know that that the chairman of the current Fed has been channeling his inner Paul Volcker for some time now. What do you say to that?
Yeah, I think, look, the uptick in inflation, headline inflation from 3 to 3.2 is not a big jump, but it's the first jump in over a year. So it shows that it's not going to be this easy path down to 2% and then all things are good. So the Fed is watching the upside pressure from the reflation trading commodities, from sticky wage inflation, which has really been tough to get down. Now, on the flip side, you have a disinflationary trend in housing that should be a tailwind for headline and core inflation over the next several months. But the Fed is watching things like the wage growth in the job market, and they're concerned. So what is higher for longer? You know, the Fed wants to get another rate hike in. We know that. And then I think they want to keep rates in that 5.5 range into 2024. Longer is relative. It's not going to be a couple years because usually the Fed hikes rates and then finds themselves cutting them very quickly afterwards because something has broken in the market. So higher for longer could just mean into 2024, maybe the midpoint of 2024. But it's a real goal of theirs. They want to keep rates restrictive, policy restrictive. They're still pursuing QT, and they want to get inflation back to 2% by any means necessary.
So, Ross, I want to ask you, do you feel like the market is pricing this potential of higher for longer, right?
I think we're starting to see it, right? You're starting to see it in yields across the curve. You're starting to see it in Fed fund futures. The market has underestimated the Fed for a lot of this hike upwards. They didn't appreciate that the Fed would actually be able to pursue rates this high, that rate hikes would go from 25 to 50 to 75 basis points. And so the market has been caught off guard at different points in this rate hike cycle. Last time I checked, the market was kind of, wishy-washy on whether the Fed would get another hike in even this year. I think the Fed doggedly wants to. Inflation is not giving them a reason that they won't be able to yet. And so I don't know that we're fully priced for it, but I think we're starting to get there. You can see it in the equity markets taking a pause. You can see it in the bond markets with yields heading higher across the curve. So we're getting there, but I don't know if we're fully there yet.
So let's talk about what to buy or where the opportunities are. I'm looking at your notes here. It looks like you like industrials, consumer discretionary, XLY, one of the leading sectors, large cap consumer discretionary today. How does this translate into what you might expect for the rest of the year?
Yeah, so the broad base case or idea of the market right now is we're in a cyclical bull that's in the middle of a kind of a seasonal corrective phase. And so the leadership going into that, industrials, discretionary, some of those more cyclical sectors, we think will ultimately continue to be leadership once this corrective phase kind of settles out. So, we like the cyclical parts of the market. The defensive areas have given us nothing all year and continue to look weak. I might pair that with some high quality fixed income. Again, yields pushing up at 15-year highs. And ultimately, once you do get to peak Fed, even if it's farther out than the average investor might expect, you get the one-time, capital appreciation from yields falling. So I think that trade works well, that pairing. But we still think we're in a bull market, even though things are looking a little gloomy right now. And so we want to be owning those economically linked sectors on our way out and into the back end of 2023.
So, Ross, the tech sector has been a standout. Today, no different. Is the AI play overplayed?
These big themes, and I'm not breaking any ground here, they tend to be overestimated in the short term, underestimated in the long term, right? You're seeing some of the AI linked plays really rallying, and obviously the earnings of Nvidia on Wednesday will be kind of a flashpoint as they're one of the leaders in the space. But I do think there's a lot baked into these stocks right now, and the follow through in the near term. While it's been impressive and while there's real investment, real pull through to the bottom line for a lot of these companies, it's probably a little overestimated in the near term. Valuations are pretty extended, especially as you move down the cap scale in some of those names. So probably a pause or maybe just a break needs to be taken. But it's a theme that we have belief in, and we think that over the longer term, the winners are going to be real standout winners.
I'm wondering what you're thinking about the current earnings season, which is wrapping up here, and then into the end of the year, because we came into this year with really low expectations, negative implications for earnings, and that just did not materialize. What are you seeing now in the current quarter, and also looking ahead to the final 2 quarters of the year?
Right. Well, we've had economic surprises over the last several months, and you can see it reflected in earnings. So earnings ex energy, which was a real drag this quarter, were actually up again against depressed expectations. But that's been the theme of the year, is beating expectations. The recession hasn't materialized, and so we're not seeing earnings that would be associated with a recession. It's going to be flat. It's not exactly awe-inspiring, but you're not getting the big trough. You're seeing profit margins importantly stabilize, and earnings are really expected to ramp up into the end of the year in 2024. I will say we need that to be the case because valuation is a bit extended here, especially where rates are. But so far we've seen no reason that won't be the case. Again, the economy in Q3 has reaccelerated. The Atlanta Fed's GDP now number got a lot of play because it's up around 6% real GDP. That will flow through to earnings. The consumer has been resilient. So we expect the trough to be around Q2, Q3, and an acceleration into the end of the year. Again, profit margin stabilizing here is really, really important given all the pressures on the cost side of the books.
And Ross, I want to ask you, so to your point about, I guess, kind of the takeaways on this latest earnings season as we're winding down, we have a few big players to come up. We have Nvidia, we've got some big retailers still left to report. What stood out to you as a theme? Because I know the previous earnings season, it was all about AI. Is it the kind of profit, the margin stabilization piece that stood out to you? And I have a follow-up question I want to ask after I just hear what you have to say on that.
Yeah, I think margins are an important part of the story. I think The year of efficiency or managing the cost side of the books has been really important, and companies have been really effective in doing so as top line growth has slowed. So I think that's really important. Typically, you don't get recessionary earnings unless profit margins contract quite a bit. I think the other thing outside of AI that you have to watch is just what are the consumer-facing names saying about the resiliency of the consumer. There are a lot of well-known headwinds coming up, whether it's the depletion of excess savings or the resumption of student loan payments. And yet most of those names have said the consumer is doing okay, maybe some trading down, but not painting a picture of a falling off a cliff of the consumer spending that might be expected.
And Ross, I want to ask, to your point about that kind of year of efficiency. I remember Meta coined that. Companies can only cut so much rather, before they actually have to generate revenue. And in terms of the issue with the consumer trading down, we saw that play out in different ways. Like, let's say Target and Walmart. Walmart did better with the consumer continuing to trade over to Walmart. Target didn't do so well in terms of sales, but their margins improved. So in terms of just the strength of the consumer, are we expecting to see that kind of hold up in terms of the earnings when it comes to these latest consumer-facing companies that have to report and through the balance of the year?
Yeah, I think the consumer, it has to slow a little bit, but we just got a retail sales number last week that was well above expectations and continued to paint a picture of a consumer that was out and spending. The other thing you have to focus on when looking at some of these consumer-facing retailers is the inventory management. So a lot of them were caught flat-footed by the shift in spending on goods to services. That is normalizing as well. And you actually might be getting a tailwind from that after a year of struggles in some of those names. So I don't know if the consumer can on its own carry the US economy, but there are other pockets of the economy picking up. I still think the consumer has legs because the labor market is still so strong. And so I think the spending picture is going to be fine. And, top line growth is linked to the economy. We're seeing an acceleration in real GDP expectations. And so we expect that to play out in the back half of the year.
Yeah, Ross, you definitely will put a pin in a conversation there, but it's a great point about how the labor market has continued to remain strong in the face of call after call with regard to some destruction there, which hasn't come to pass, really. All right, Ross Mayfield, Baird Investment Strategy Analyst. Thanks so much for joining us today.
Thank you.
And let us check in now on some of today's top trending tickers. And we're going to start with Palo Alto Networks. They're surging higher today. Stock having its best day in 2 years after a better than expected earnings report after the bell Friday calmed investors who were concerned about the unusual timing of the announcement. Wall Street was bracing for the worst, but bad news never came. Instead, Palo Alto Networks came in mixed. Those results announcing decently bullish guidance for the longer term. Analyst reaction is largely positive for the company, with some saying the company's results bode well for the entire cybersecurity industry. Truist, for its part, they raised its price target by $50 to $275 per share, saying the results were decent given the challenging macro environment. And when it comes to AI, Truist is saying that PanW is, quote, committed to capitalizing on the rapid growth of data with generative AI and is one of the best positioned security companies to benefit from vendor consolidation based on product breadth. And Diane, I'm going to give this to you, but I just want to chart this on the Wi-Fi Interactive one time here, if we can pull that up, because this is a 3-year chart. We just came down, breached support here, classic pattern here, then we gapped up and left all those bears behind. So pretty strong pattern there.
Yeah, it's turned into a really fun story to talk about, because it was just really this kind of what is going to happen, this boogeyman kind of story. Why are they dropping these earnings on a Friday heading into the weekend? It's very rare when you see something like that. The most recent time that happened was Nike in 2020, but it's rare outside of Berkshire, which always reports on Saturday.
Exactly.
Right? It's random, but Warren Buffett can do that. But it's like, I like the note the Jefferies analyst put out to Jay, calling it, quote, flying over the firewall of worry. And, the executives talked about how the choice of Friday certainly made them a big topic. And, and I remember when that came out, it was like kind of a nothing burger in the sense of.
I was excited. I didn't have anything to do on a Friday afternoon. I don't know about you. You were sitting here.
I was here. And it was like, so just really quickly, one of the notes that was out right ahead of it, a riddle wrapped in a mystery inside an enigma. So it wasn't as much of a mystery as it turned out. They really were it was true what they said. They were trying to get in
Pretty
front of
good
their
results.
sales meeting. Yeah, and it was, so better than expected. Another stock we're watching, shares of Tesla, those rising. It's up almost 7%, just at 7% on the nose right now. It has its sights set on ending a 6-day losing streak. This comes as Baird analyst Ben Cowell highlighted some positive developments ahead of the EV maker in the second half of the year. That includes the launch of the Cybertruck. We've been talking about that. Continued growth in the energy business and expanding into new markets. So it's definitely been helpful for the share price today. It's the best ideas list, right, Jared?
Yeah. Well, let's take a look at the Wi-Fi Interactive. I got some charting to do on this stock. First of all, this is a heat map of the entire sector today. So EVs are doing well. A couple like Volkswagen not performing well, but let's take a look at over the last month. You can see they have been struggling. Most of these names have been struggling with the exception of the Chinese automakers and Toyota. But we're talking about Tesla. Let's chart Tesla here. This is a stock that has come off of its highs. And in fact, I was doing an analysis on Mega Caps Friday because I had nothing else to do. And I was looking at recent drawdowns from 52-week highs, but Tesla was one of those companies that they didn't top last year or 2020. It was like 2020, 2021 there that we're seeing those highs. And so they are significantly still off those highs, but they are in an uptrend right now. They're at the bottom edge of this little channel that's forming. And if growth stocks can succeed today, if they can surge today with surging interest rates, I would say, well, perfect environment for Tesla to surge as well. We got to move on to meme stock central because AMC shares, they are sinking today as investors feared further dilution of their common stock. AMC stock conversion may proceed this week after Delaware Supreme Court decided not to stand in the way of a settlement approved earlier this month by Delaware's Court of Chancery, which cleared a path for AMC to convert its preferred equity units, known as APEs, into common shares. Now, the company has said that the APE units would cease trading on August 25th. And I just want to go back to the Wi-Fi
I figured you were going to your charts.
one more time to just show what the two different shares have done today. In the cyan, those APE units are down a little bit. And guess what's down a lot more? The AMC, the common stock.
It's going to dilute the shares that are out there.
Usually these two move in opposite directions, but I'm not attaching any fundamental biases to any kind of analysis regarding this company anymore. This is just the way it's happening.
No, and it's an unfortunate meme play for those who may be holding the bag, if you will.
Well, that's kind of the nature of meme plays, it seems, but we don't know the final ending there. So I'm not going to say that has a dire outcome.
This is, okay, that's fair. We don't know the ending yet.
All right, we're just getting started here on Yahoo Finance Live. And coming up, Nvidia is leading the earnings story this week. The company is set to report its second quarter results after the bell on Wednesday. We're breaking down what to watch from the tech giant. Plus, COVID vaccine stocks on the move as new virus mutations are gaining ground. More on what you need to know later in the hour. And former President Donald Trump has pulled out of the first GOP primary debate this week, claiming voters already know who he is, but do you know the other candidates? That and much more when Yahoo Finance returns. Nvidia is a stock Wall Street is watching this week. The chip giant reporting earnings after the close on Wednesday. Stay tuned for that right here. The expectation is that Nvidia is going to guide above analyst estimates, but the question is really by how much. The report will also be a test for the stock's 200% rally this year. And joining us now is Bernstein Managing Director and Senior Analyst Stacy Rasgon. Stacy, thank you for being here today. What are you expecting Wednesday? Because the hype seems unbelievable right now. Is it possible they gasp disappoint?
No, I think the numbers should be good. The question is, like, obviously, clearly expectations are going up and higher and higher every day. So that'll be the question. But I mean, the numbers objectively should be very, very good. Demand is off the charts. Any limitations on what they can report within their data center business this quarter, frankly, for the next several quarters, are probably going to be much more around supply rather than demand. They're going to be selling everything that they can have made. So I think the numbers overall should be good. It's kind of funny. I almost don't want them to be too good because like expectations into next year are already quite high. Like I'd rather not see those expectations go even higher. So it'll be a little bit of either or. But I mean, in general, the numbers should be very, very good relative. I think at least where the sell side consensus is today.
So Stacy, I want to ask you, so Nvidia is, far and above the leader when it comes to AI. Do they kind of have the market basically cornered in this area?
Yeah, I mean, right now, look, so there's only a couple of companies. There's a lot of companies out there that have like an AI narrative about them. There's only actually two that are showing real, like, actual dollars right now. It's Nvidia and Broadcom, and that's about it. And Nvidia's like here, and then you got everybody else, which is like pretty far below. So they do kind of have it cornered right now. There are other players that are trying to develop products for this market. You've got like AMD. There's a story as they get into next year and they have other products that are there. And you've got Intel and you've got some others that are trying to do this. You also have some of their large hyperscale customers like the Googles and the Amazons of the world that are building their own chips, which is not new. They've been doing their own chips for many, many years. But you have that aspect as well. But in terms of sort of benefiting from the swell of demand that has occurred with AI, probably since the beginning of this year, it really is Nvidia that is in the driver's seat, yeah.
And the hype that's surrounding Nvidia largely began around their previous earnings announcements, where they just announced this guidance that blew past analyst expectations. And I believe your firm has done an analysis whereby their four biggest customers could easily deliver that guidance. And so anything else presumably would be gravy?
Yeah, well, so you're right. So last quarter's guidance was pretty astonishing. I had to look at the number twice. Like it didn't register in my brain. I've been doing this job a fairly long time. I've never seen a guide like that from an established, like at-scale company like we saw. So that was pretty unbelievable. If you do the math, so they're guiding total revenues, and again, I think expectations are that they'll do better than this, but they're guiding total revenues at about 11 billion for this quarter. If you sort of work through it, the implied guidance for data center this quarter is about 8 billion, which is roughly a $4 billion incremental data center growth this quarter versus last quarter. If you sort of do the math on some of the larger like hyperscale customers, and they've all guided CapEx, the CapEx increases from four of them would be enough to account for that $4 billion incremental. There are clearly lots of other customers besides those four that are buying these parts. But yeah, I think that the company's like at least implied guidance, the way they laid it out for this quarter, is easily doable given what we've seen in the supply chain and given their customer demand.
So there's been a little bit of talk about this, not much yet, because given the early days, about the potential for a bubble, an AI bubble. I don't know that we would say that Nvidia is there. Is there the potential for that, and how long? What's the kind of trajectory for that, if there is?
So at some point, yeah. So I mean, right now demand is off the charts, but again, supply is very limited. So customers can't get what they want, and there's a general behavior that happens in semiconductors and lots of other places. It's called double ordering. When people can't get what they want, they order more. This is the toilet paper situation from like 2020. It's the same kind of dynamic. And that sort of thing, and forget Nvidia for a minute, just in general, that sort of behavior happens. And so the fact that demand is so strong and supply is so tight right now, you could potentially worry about an air pocket or something. And with Nvidia, that's one of the primary controversies is this new level of demand that we see. Is that sort of the new baseline for growth? Or is it like pull forward and panic buying, and is there an air pocket? And look, I will be honest, at some point, what is the chance that Nvidia will see an air pocket? It's probably 100%. We've seen them before. We'll see it again. I mean, look, the stock may have a 50% drawdown in it again at some point. We've seen those before. It might be $1,000 to 500. Like, I don't know. Like, we'll see it. Am I worried about an air pocket? Like, right now, absolutely not. Like, we're certainly not going to see one this year. My guess is even next year is just fine. Like, calendar 25, like, by the time we get there, maybe we'll know a little more. But, like, I guess we'll worry about that a little when we get a little closer. And frankly, the actual run rate that we could be seeing by the time we get there could be materially higher than what we see. And I will say along those lines, if I'm looking at 5 years or 10 years, I'm convinced that we would be talking numbers at that point that are materially higher than what we were talking about today. You have to remember, we are still very early in this whole thing, like ChatGPT and all this other stuff that's gotten people excited. It's only been here since November. It's less than a year. We are very early on the whole progress of the AI cycle. They'll probably overshoot, they'll probably undershoot. This is semiconductors. This is why we get cycles in the industry. I'm not worried about at least the next like 12 to 18 months, maybe even longer. I think we're okay.
Okay, so we don't have to get into 2026 predictions right now, but let's say there is a problem with overcapacity at some point. You could say the origins of the internet in the 90s kind of has some examples for us, especially with regard to fiber optics build out. And Nvidia has been here before. When crypto first took off in 2017 in a big way, there was a lot of disappointment when the crypto bubble popped and suddenly all those GPUs were not as necessary as people thought. Any potential overcapacity here, or is that just demand is so flying high that we don't have to worry about this?
So I would say at least like with data center and AI versus crypto, it's a little different. I'd say the AI thing is at least a lot higher quality than maybe the crypto bubble was. And we all knew at some point crypto was going to implode, right? That was known, and it happened. AI, I think, is more sustainable. Like this, I guess we can have arguments on whether or not crypto should be a sustainable trend long term. I'm not convinced that it is. I think AI can be. I think ultimately, like what really needs to happen is like you think about who's buying these parts right now. It's primarily the hyperscalers and some of the startups. I don't think it's a ton of like on-premise enterprise adoption yet. Ultimately, it's the enterprise customers that have to build business models out of this, whether it's like revenue or whether it's cost savings, but they need to get a return. They need to get an ROI on these investments. I would say the biggest structural risk, which I think is what you're getting, is over time, if it turns out that customers cannot get a return on these things, if there are no viable business models that can get built on this, that would be the biggest risk for like not just an air pocket, but like a structural like an under demand scenario where like the demand levels that we're seeing are just not realistic. I'm not convinced that that's true. I actually think we're already starting to see real potential demand models. We have Microsoft where they have this Copilot where they've announced a revenue model for it that actually you can get fairly big numbers and good returns. We've had other companies that have talked actually about slowing hiring and things like that. So there's cost savings that can come from this. So I think there are business models that can be developed from this. But I mean, the biggest structural worry long-term would be if business models, viable ones, cannot be developed from this, that would be a problem. Like you would discover that we're overshipping now because of this. I don't think that's the case though.
But you make a great point about for instance, the hyperscalers and the startups who this makes sense for, who are in that space. We'll certainly see if the use case plays out in other areas that it doesn't come natural to when it comes to AI, and particularly when we're talking about generative AI. We'll have to bookmark our conversation. Stacey Rasgon, Bernstein, Managing Director and Senior Analyst. Thanks for joining us today. Coming up, a flurry of home data out this week with new and existing home sales numbers set to be published as mortgage rates sit at a 2-decade high. We're discussing the latest housing hurdles when Yahoo Finance returns.
officials descending on Jackson Hole next week for the Kansas City Federal Reserve's annual economic symposium will face the question of whether inflation is on a convincingly downward trajectory or whether more interest rate hikes are needed to bring down inflation. Inflation has cooled on a headline basis from a peak of over 9% last June to just over 3% this July. But stripping out volatile food and energy prices, inflation sits over 4%, double the central bank's inflation target of 2%. In his last comments at the Fed's policy meeting in July, Fed Chair Jay Powell wasn't convinced on inflation yet to let off the gas and said he needs to see leftover distortions from the pandemic on supply and demand ease.
Policy has not been restrictive enough for long enough to have its full desired effects. So we intend, again, to keep policy restrictive until we're confident that inflation is coming down sustainably toward our 2% target, and we're prepared to further tighten if that is appropriate.
Traditionally, Fed chairs have used their speeches at Jackson Hole to put forth major policy messages. This year expected to be no different, with investors hanging on Powell's every last word.
Shares of COVID-19 vaccine makers surging higher today, as you can see on your screen, as new variants of the virus start to gain ground and hospitalizations begin to rise. Yahoo Finance's Anjali Khemlani is following the story and joins us now for more. Anj, the details, please.
Absolutely, Jared. So we know, of course, that the World Health Organization has been tracking a number of variants. And here in the U.S., we're starting to see an uptick of one. That's the EG5, nicknamed ERISA unofficially, as well as the BA286. That is another one that has caused some concern. EG5 of concern because of the fact that it is a little bit more immune evasive, but that is all in the contributing to the story of these vaccine makers. Up on the news that there is something to be concerned about. We know that they have all demonstrated some efficacy against this new variant, even though they have been programmed to really and formulated to fight the XBB.1.5. If you remember, that was the Omicron variant at the time. This new one, EG5, all of these variants that we're seeing are part of that broader sublineage, that Omicron family. So the expectation is that they should be effective come the fall when they do need those shots. Now, it's important to note that the three vaccine players, Moderna, Pfizer, and Novavax, are yet to get approval from the FDA. They're still conducting their efficacy trials and should hear soon. There's some concerns that the rollout might not take place in September as planned, but there still is a timeline awaiting. So we have to wait and see how that all pans out. But as of right now, experts aren't warning that this is necessarily going to drive a surge the way that we've seen in the past during the pandemic, but definitely are seeing an uptick in cases attributable to these new variants. So something to keep an eye on out for as the fall continues.
Yes, and we know you will keep an eye on all of that for us. Yahoo Finance's Anjali Khemlani. Thank you.
All right, we are expecting to get a much clearer picture on the housing market this week as new and existing home sale data set to be released. It comes as mortgage rates hit a two-decade high at 7%, which has stalled the market, along with issues of inventory and high prices. Joining us now is Lawrence Yun, Chief Economist at the National Association of Realtors. Lawrence, thanks so much for joining us today. So I know last week when I saw that number of mortgage rates hitting 7%, it was a shocker to me. I was alive in the 80s, though not old enough to kind of know anything that was going on. But I want to ask you, are you expecting them to go even higher?
The 7% mark, last time it crossed that was back in November of last year, and that brought the home sales down in December and January. So clearly indicating the sensitivity of the housing sector to the mortgage rates. So right now the mortgage rates are touching that cyclical high level. I don't think it will break higher. I mean, I truly wish the Fed would stop raising interest rate, because they are clearly overreacting. The overall inflation rate is calming down. So if the Fed basically say they're done, I think we could see mortgage rate trend down back towards 6%, which would be great news for all the potential home buyers, but also home sellers. Home sellers have been resisting to list their property, but with lower interest rate, maybe the cost of giving up their 3-4% mortgage rate becomes less painful.
You know, you're outlining a number of the dynamics that are making this market a bit of a head scratcher for some people, as we have people who do not want to relinquish their homes or sell their homes because they're enjoying those very low interest rates. But the fact remains, we have new home builders hitting record highs this year in terms of their stock. If you would have told me that at the beginning of the year, I would have said, no, that's not possible. But nevertheless, here we are. The housing market has proven quite resilient. Do you believe that there are just structural and structural factors that are just providing this incredible tailwind? And I'm just wondering what you see as maybe the cyclical and the variable factors right now.
Well, the long-term factors are about population growth and job growth. The job levels today are 4 million more people working compared to pre-COVID record highs. So we are continuing to add jobs, and naturally people have dreams about owning a home. So that is providing this steady interest in the home buying, while the cyclical factor is mortgage rate. That determines the timing of whether people can get into the market or whether they are pushed out of the market, depending upon their finances. We have seen the cash share transaction begin to rise because people who have substantial housing wealth, say in California, they're selling their property and going to nearby adjacent states of Idaho, Nevada, and purchasing all cash, just completely bypassing the mortgage market. So it is a very interesting market, and also very little distressed property sales, even though home sales are much lower.
Lawrence, I want to ask you, so we're going to go from Wall Street to Main Street here. You mentioned the word dream. A big part of the American dream is owning a home. Affordability has become a serious issue once again. Is the American dream dead?
Well, American dream is alive. Is whether or not Fed will permit that dream to be realized. Because if the mortgage rate was to somehow go up to 8%, now by historical standard, that is still not that bad, but by recent standards, that is very high, and it's going to price out many young adults out of the marketplace. So it's going to create a huge social divide. Homeowners smiling big, while the renters feel like their dream is out of reach, frustrated that other people are getting the housing wealth while they are left out, paying higher rents each month. So we don't want to create this persistent social divide. So one way to assure that there is a path towards ownership is to make sure that the economy is working correctly, and so far jobs are being created, even though now the numbers become a little less robust job creation. But the Fed, I mean, they have to look what the inflation will be in the future, and the future inflation, say by December, will be well under 2%, because the heavyweight component, the rents will be coming down for the simple fact that apartment construction is at a 40-year high.
All right, let's say mortgage rates do top out now at about 7%, maybe a little higher. Have you done the math? Do you know if they come down to 6% to 5%, what kind of value and what kind of deals that unlocks for the average home buyer here in the U.S.?
Well, you know, if the mortgage rate was to come down, we always say that people on the fence, the buyers, are now in the fence and begin to search for homes. So we will have increased demand. But what will be unique in the current cycle is that as the mortgage rate decline, all these pent-up sellers are people who are currently living in a home, but they have additional child in the family. Maybe they got married, or maybe they have a new job at different part of the town. They want to make those move, but they don't want to make the move if the mortgage rate is very high, where they don't want to give up their current low mortgage rates. But if the mortgage rate begins to come down, some of the sellers will say, well, it is still painful, but not that painful, and they will make the move. So increase in demand and increase in supply as mortgage rate come down.
Well, we will certainly see what happens when we get some new data on this week on both sales and the next level for rates. And of course, we'll be watching to see where the Fed goes next. Lawrence Yun, Chief Economist at the National Association of Realtors. Thanks so much.
Thank you.
Coming up, Barbie dethroned. There's a new movie at the top of the domestic box office. More on that when Yahoo Finance returns.
Good morning. This is Yahoo Finance.
Big news, 3 things that you need to know.
We just got the announcement.
What happens now?
I got a question.
What does success look like?
What was one of the biggest challenges that you faced?
How much does that raise the odds for a recession?
This phase is over. Tell me what happens to the debt ceiling.
Where does generative AI, though, fit into your portfolio?
Talk to us about this diversification and what investors need to know.
And I think it's important. This is the stuff that gets me out of bed, fired up.
What's the gateway? What's the new bridge to opportunity?
Doesn't matter if it's a soft landing or a hard landing.
Big interview. I can't wait.
Supreme Court out with the ruling on President Biden's student debt cancellation.
Right, let's turn now to some recent tech earnings. And they give you information if you watch them closely.
President Bostic, President Investor Gary Gensler, thank you so much.
Part of what Davos is about is sharing best practices, coming forward with ideas, and then enabling those ideas into action.
And I would add that there's more to come on this.
And we keep producing products that help people lead healthier lives.
This is one of those rooms they use to simulate light in space.
Interest rates will come down again.
Figure out where your money is going now. You gotta scope that out.
And the numbers really tell the story.
What does all this mean for you?
Keep it tuned into Yahoo Finance.
Barbie dethroned. Barbie had dominated the domestic box office since the film came out in late July, but another movie topped the charts this weekend. Yahoo Finance's Alexandra Canal has the details. Allie, take it away.
So Barbie dethroned for now. You never know what's going to happen.
Could make a comeback.
It could make a comeback, but it's an interesting film to do it. We have Blue Beetle, which is the latest superhero film from the DC universe. That is a franchise that certainly struggled recently, especially at the box office. And despite being number one, there's really no exception here. I mean, Blue Beetle had pretty soft results, just 25.4 million domestically. It did nab an additional 18 million from overseas, but that's one of the softest debuts in the history of the DCU. Now, Warner Brothers Discovery, they blamed Tropical Storm Hillary as part of the reason why the box office results lagged a bit here. David Zaslav, he's certainly been trying to turn around the franchise overall, but this film, it cost $100 million to make, not to mention all of the marketing costs as well. So that's going to take a lot more if you want a chance for this film to be profitable. So all that to say, not a total win for Blue Beetle here, but let's also have some context too, because Barbie, I mean, that was number one for 4 weeks in a row. It's set to overtake the Super Mario Brothers movie as the biggest domestic release of the year. So in my view, still Barbie box office domination, I'd say.
All right, Allie, I have a confession to make. I have not been to the movie theater since before the pandemic. I hear this Sunday something might be happening that might even entice me to go.
I think you should go this Sunday, Jared, because we're talking $4 movies or less. And that's any movie, anytime, any format, which includes IMAX as well. And IMAX tickets, they could cost you anywhere from 15 to 20 bucks. So for those that haven't seen Oppenheimer in IMAX, maybe this Sunday is when you should go. But this is all in honor.
Take the family, except not
exactly.
Oppenheimer, maybe.
Exactly, right? This is all in honor of National Cinema Day, which is basically just a day to celebrate the movies from the Cinema Foundation. Last year, this day resulted in the highest level of attendance in 2022. And if you have a lot of foot traffic, that means more people are spending money at concessions, more drinks, more popcorn. That all helps movie theaters as well. And it's coming at a time where we are above where we were last year, more than 16% at the box office. We're still lagging 2019 by about 5%. But considering where we were at, I'd say we've come a long way at theaters.
Doing better than New York subway traffic.
Oh, there you go.
What a frame of reference, Jared.
All right, well,
but that's fine. That's fine. We don't need that to come up right now.
But I do take the subway. That's all right. That's good stuff. All right, Alexandra Canal, thanks so much.
Thank you.
Thanks, Allie.
And Bitcoin, you can see it there on your screen, a 3-month chart of Bitcoin trading to the Dow, well, actually up about 12 basis points over the last 24 hours, but largely trading down after that steep sell-off last week. Just want to show you another chart here. Here's the 10-year T-note yield climbed to above 4% and beyond only last week. Is there connection? We want to turn to more of this. We turn to Scott Melker, host of the Wolf of All Streets podcast. Thank you for joining us here today. I've been looking at the move in Bitcoin and just kind of falling out for no reason. Some people are blaming high rates. Maybe that has something to do with it. But what are you saying here?
Well, I think that anytime we see Bitcoin or any market move for that matter, we tend to try to assign a narrative to it afterwards. And that's not really worth doing in this case. If you actually take a look at the data, it's very clear what happened here. It's something that happens in every market. It's a long squeeze, right? You had someone with a massive spot position who sold all at once. And effectively, that entire move happened in less than 15 minutes. So what happens there generally is that they sell down on a spot position. They're probably short with margin or with leverage. They profit from the cascade of liquidations on the way down, and then they're probably the one buying at the bottom as well. This is sort of similar to the short squeeze you saw on GameStop a couple of years ago to the upside, and that's probably what's happening here. We had historically low volatility on Bitcoin, literally the lowest it's ever been for this highly volatile asset coming into last week. And so in that environment with low volume, low liquidity, it's the perfect moment for somebody to push the market in one direction.
So Scott, it's Diane here. We've talked before. And you say the crypto winter is over. There are definitely clearly signs that the crypto winter has been over, but certainly caught a cold recently. So are you saying this is a one-off event and not a kind of trend that we should be watching?
I don't think there's a reason to suspect that we're going to new lows like we did after the FTX collapse, unless, of course, we have some other massive black swan event. I just don't see that in the cards right now. Actually, the price where it's sitting, if you're looking at it from a technical perspective, anything above 25,000 is still effectively in this new bullish trend. That was the line that was broken, was the first time that we broke that bear trend down from 69,000. It was the first higher high if you're someone who looks at charts. So there's no reason to think that now. I think what we had here was we had extreme bullishness and optimism on the news that BlackRock was applying for an ETF. Right. And of course, that means that the market is pricing in that ETF approval. And the longer we get from that application to that approval, the market just sort of drifts down. But if you take a look at the way Bitcoin has traveled and moved over the past 4 years, we are just in the midst of another 4-year cycle in the exact same place that we were last time. And listen, as I said to you probably before, crypto winter may be over, but spring isn't always that fun, right? There's a lot of bad weather in spring, and I think that we might just be in the midst of that spring heading into summer next year after that Bitcoin halving in the 4-year cycle.
Hey, I do spring cleaning every spring. Got to clean out that portfolio. So I get that. I want to. You mentioned the ETF a second ago. I want to stick with that because on the regulation front, the SEC seems to not be as onerous as it has been. As at least Gensler, not as hostile to crypto. Coinbase really asserting itself. They just got approved as a futures commission merchant. They can directly offer their clients futures now. Do you see the regulatory environment easing a bit, maybe finally allowing for these spot Bitcoin ETFs to be approved?
Listen, I only listen to the experts on this. My friends Eric Balchunas and James Seifert at Bloomberg are their ETF experts. They're pricing at a 65% chance of an approval of a Bitcoin spot ETF this year. Much higher chance of seeing Ethereum futures ETFs because they're similar to the Bitcoin futures ETFs that have already been approved. So I do think that we will likely see that. As for Gensler and the SEC, let's be honest, they're taking a beating left and right. They're losing everywhere in court. They lost on Ripple. They're likely to lose on Grayscale. I think that we saw the pendulum of the anti-crypto army and the Elizabeth Warren, Joe Biden, sort of Gary Gensler side push way too far in one direction. And now they're getting a ton of pushback, not only from the community and their constituents, but also from the legislators, right? We've seen the markets bill pass bipartisan in committee through Congress. There's really some movement for sensible legislation on Bitcoin and crypto. And I think that at this point, it's likely that Gensler and the SEC throw a bone and approve a Bitcoin spot ETF, because then they can say, look, we did something right. Bitcoin is safe. And that doesn't really speak to their opinion on altcoins, which is a whole different conversation anyways. So I do think, listening to the experts, we have a very likely chance that we will see this spot ETF approved, and that would be massive for Bitcoin.
And Scott, I want to kind of go back to something you talked about with like the patterns, I guess, now that we're seeing. So Bitcoin and other parts of crypto old enough to, I guess, experience cycles. How do you survive these kind of cycles, especially like we just threw up a chart of some different coins. So we had Bitcoin trading one direction, Ethereum, Bitcoin under a little bit of pressure, Ethereum actually under some pressure now, but had been popping a little bit. How do you kind of manage the cross currents and these, I guess, cyclical patterns that could be coming into play and dealing with any potential bearishness or risk off trades that happen there?
You buy because you have a low time preference and you look at 5 or 10 years in the future and you don't obsess over 5 or 10 months into the future, right? Assuming that this cycle, which has always played out, does again, we're looking at a year from now being a few months after the halving and really starting to see that reduction in supply that's mathematically programmed into Bitcoin starting to play. So I really think that if Bitcoin goes back to 69,000 eventually, or to 100 or 150, or the much more hyperbolic, obviously optimistic takes that a lot of people have, you're not going to care if you bought at 29, 25, or 20. So I can tell you, I personally filled bids at 25,000 on this drop. I have more bids at the 20 and 19,000 level just in case we get down there. But the truth is, it's too late to sell, right? You should have been selling at 69,000. It's not financial advice naturally. But if you look at these cycles, the big players sold on the way down, and you can look at their wallets. This is very transparent. They're buying now and have been buying now for months in anticipation of this cycle. So I think you either do nothing, but if you do have some dry powder, you start to put some bids and hope they fill before we head back up.
All right, we're going to have to leave it there. Really appreciate your insights. Learned a few things here. Scott Melker, thank you. Coming up, the closing bell on Wall Street, we're going to check in on the latest market moves and the top trending tickers. Stay tuned.
All right, that is the closing bell on Wall Street. Let's do a check of the market action to see where things are shaking out. We got a little extra ding on that bell today. The Dow did finish. It was the laggard of the session, lower, down 35 points, but well off the lows of the session. The S&P 500 flipped positive this afternoon and has kind of stayed on that side, up by more than 0.5%, up 30 points. Nasdaq, the leader, the tech sector, once again, the belle of the ball, better by more than 200 points, finishing the day up 1.5% as we continue to see investors pile into that tech/AI bet. And, pulling away from some of that risk off trade that we saw last week. Let's check in on how some of the top trending tickers closed today. One of those in the tech sector, namely the AI space. Shares of Nvidia finishing the day up strong, rallying about 8.5%, leading the earnings story this week. The company set to report its second quarter results after the bell on Wednesday. The bar is being set high after Nvidia smashed analyst expectations last quarter, and they gave that kind of forward-looking guidance, projecting revenue would be up more than 60%. We know that Nvidia is the leader in the AI space. They account for more than 60% of those chip sales. It might be 70%. It
depends on the market. I'll take that and kind of run with it. We were talking to an analyst from Bernstein in the last hour about Nvidia. It was difficult to get him to talk about any of the problems facing the stock that might materialize over the next few years. They're just very well positioned to capitalize on a trend that is only set to continue. So let's go to the Wi-Fi Interactive. I just want to chart the intraday price action of Nvidia here. That is just a bowl. Look at that. From almost no pullback in there. And then let's take a look at the year to date, because guess what? This is the record high over in July. Well, we sold off a little bit, but we're almost right back there. So this is nothing but another consolidation. And we're going to be watching with bated breath, I believe, those earnings in Wednesday. We could surge beyond those record highs. We could collapse back down to support, but I think it's going to be a blockbuster either way. And also have to stick with tech here. We're tracking shares of Palo Alto Networks closing the day higher, with the stock having its best day in 2 years. And that's after a better than expected earnings report after the bell Friday calmed investors who were concerned about the unusual timing of the announcement. Truist, they raised their price target by $50 to $275 per share, saying the results were decent given the challenging macro environment. Yeah. And this is another stock that has been doing quite well. Now, they fell off a little bit more. If we can go to the Wi-Fi Interactive this year, I will show you they took a bit of a tumble, but arguably they are right back up in the upper end of their range here. Let's draw this from their previous highs, $200, and just another tech success story here in the face of these surging yields, which is a little bit of a head scratcher, but nevertheless, this is what's happening, Diane.
Yeah, I know. And then, what was interesting about Palo Alto is the story that we started talking about late Friday because of that unexpected, timing of the earnings announcement. And it wasn't the boogeyman that everyone expected. And, it was kind of much ado about it. It ended up being like a Chicken Little kind of situation with all the analyst notes that went all out about why are they doing this? Is there an executive shuffle in the C-suite? And it was nothing. That wasn't it, And we had the Jefferies analysts who, their price target on it. They've maintained their buy rating. They have a $285 price target on that stock right now. So Palo Alto faring well, especially when you consider how much heat was taken off of that stock on Friday. Another one we're watching, Nikola shares closing the day deep in the red after the EV maker said its 2023 deliveries will be at risk. This following an investigation into battery packs that led to a recall of over 200 trucks. You're looking at the stock down, finishing the day down about 23%. Nikola also announced a $323 million convertible bond deal. So that's kind of the opposite of what we're seeing in terms of just shock market action. Nikola is having a very bad day today.
And I would mention too, Nikola, their deliveries are in the hundreds, and we're talking about for the full year. This is still a smallish company. Let's go to the Wi-Fi Interactive. Just want to show one brief chart, maybe two. This is over the last 3 months, and there was huge short interest when we saw this rise to above $3 a share. You can still see they're more than 99% up. That means they've doubled over the 3 months. But let's take a look at the year to date. This stock was feeling no love in the early part of the year when mega caps were surging. It wasn't until June when we saw industrials and all these other parts of the market come in. That's when we saw short interest rise, and then we saw that bubble pop. So it's just kind of more of the same for this very small market cap company, Diane.
Yeah, indeed. And, definitely not helpful, though. Yes, it's not a lot of vehicles, but they have to deliver on that amount, and they're not. All right. Former President Donald Trump has pulled out of the first GOP primary debate on Wednesday, saying voters already know who he is, and therefore he doesn't need to show up. So now eyes will be on those on the other 7 podiums, with some setting their sights on a different billionaire, entrepreneur Vivek Ramaswamy, who has been gaining endorsements and media attention. With more on this is Yahoo's Rick Newman. Hey, Rick.
Hey guys, so what are we going to do without Trump in the GOP debate? I guess we'll probably just talk about Trump during the whole time, but maybe we won't. Maybe I'm sure the moderators will ask those candidates, those 8 candidates that look like they've qualified so far, about Trump. But perhaps we'll get some other information that we haven't heard yet. So I for one will be watching to see what these candidates have to say of substance about the U.S. economy and things we care about here at Yahoo Finance. One of the things Republicans have been bashing Biden on, obviously, is inflation, but that they might need a plan B on that, because inflation has come down a lot in the last year, and inflation may not be a problem by this time next year. So I'll be looking for whether there are any intriguing or interesting new ideas on the economy, on trade, on technology, on artificial intelligence. It can be hard for substance to make it through some of the vitriol in debates such as this, especially when you got a lot of candidates on stage. So we'll see if any substance squeaks out.
What about some of the other races that we're looking at? Let's go to the House, let's go to the Senate. Anything piquing your interest in there?
Well, the big question is obviously, will the party that wins the White House in 2024 win the House and the Senate? The Republicans face really good odds of retaking control of the Senate, but they have a familiar problem that plagued them in 2020 and in 2022, which is lousy candidates, sort of freakishly far-right candidates that might appeal to a super conservative or a very far right-wing audience in the primary elections, but may not win in the general elections. So Kari Lake, for example, in Arizona, she lost the governor's race there, and she's been pulling a Trump the whole time, saying it was rigged. She's completely wrong. She's been lying about that. But now she wants to run for the race for Senate in Arizona. So there is a vulnerable Democrat, now an independent, Kyrsten Sinema. Republicans thought they had a good chance at beating her, but let's say Kari Lake ends up being the Republican candidate. That could be a problem for the Republicans. So that's how it's all shaping up. And the good news for me, maybe not such good news for everybody else, is we've got another 15 months to talk about it all.
Oh, that is good news for me too, Rick, because I know you're going to be right here with us. Thank you for that, Rick Newman.
Bye, guys.
Bye.
Bye, Rick.
Coming up, while some may have thought the banking crisis was over, Minneapolis Fed President Neel Kashkari has warned the end of the concerns are just starting to get underway. So what does this mean for regional bank shares? More on that when Yahoo Finance returns.
During Yahoo Finance's week-long retail special, we found out about the state of retail. But what does the everyday consumer think about it? Let's go find out. Have you noticed rising inflation impacting your spending at all? Are you spending less anywhere?
I'm definitely spending less everywhere.
I'm working, I'm making overtime, so my liquidity is a little bit more, so I'm spending a little bit more.
I'm definitely saving as much as I can everywhere and anywhere.
My dollar doesn't go as far as it used to.
I thought I would wait a month after I started school to get a job, but now I'm going to get a job in like a week because I can't really pay for anything.
Are you spending less anywhere that you used to spend more and opting out of certain purchases?
As far as food purchases go, I'm looking to spend a little bit less. I'm not spending as much money on, the frills, clothes, makeup, the fun stuff.
Clothing, I mean, you always look for the sale prices.
Eating out, probably going out with friends.
Where do you feel like you're spending a lot of your money?
Probably clothes. New York City street fashion is intimidating, so I gotta keep up.
I like cooking, so like vegetables mostly. I think they're kind of expensive.
On hair products?
Gasoline, because I drive at home. Alcohol is probably right below gas.
Are you an online shopper or someone that likes to go in the store? A lot more online. The convenience.
I would rather do it in person, but sometimes it's just easier and cheaper to do it online.
In person, so that I can try it on.
Online. I hate going to the malls.
I really much prefer in person. I was speaking with the shop owner yesterday, and he said, youngsters don't buy these kind of boho clothes, and if they do, they get it on Amazon.
Everything is becoming more bottlenecked towards the internet, so you're having a lot less choices. Amazon, it's pretty much the way we're going now.
Minneapolis Fed President Neil Kashkari warning the banking crisis might not be over. That commentary pushed shares of regional banks into the red last week. Now, 4 banks failed in the first half of the year, including Silicon Valley Bank, which faced $42 billion of withdrawals in one day. In the wake of those failures, other institutions stepped in to fill the void. One company in particular has seen customer funds grow by around $3 billion since SVB's collapse. For more on this, we turn to the co-CEO of that company, Enrique Dubugras, Brex co-founder and co-CEO. Now, Enrique, thanks so much for joining us today. So first, let's talk about what Brex is for those who might not know it. What do you all do?
Yeah, absolutely. So Brex is the first global unified spend platform. So we have corporate cards, spend management, reimbursements, accounts payable, travel, banking, all in one place. So think of a mix of your bank with all the software you use to manage your finances.
All right.
So let me ask you, can you kind of walk us through the banking crisis as it evolved from your point of view? I'm thinking this is going to make a great Michael Lewis book or movie someday. But there were some hiccups that day. And then when did you realize the extent of what was going on and what was in store for you, what you had to do over the weekend, and how did you execute that?
Absolutely. So Brex was one of the alternatives to Silicon Valley Bank. A lot of the next generation companies who were starting out came to Brex for their banking services. So because we have business accounts that has checks, wires, ACH, and a lot of the traditional non-lending banking needs a company might have. So we originally were aware of it on that infamous Thursday because we saw a lot of funds just coming in, way more than our regular kind of day-to-day funds. In the afternoon, we started getting a lot of text messages from VCs and founders and entrepreneurs saying, hey, what's going on with SVB? We didn't really know what was going on. And then on Friday, we saw that they blocked all the wires that were coming in. So we knew something was wrong. And then obviously announced the receivership later that day. Over the weekend, we raised almost $2 billion to do payroll loans to make sure employees were getting paid on that Monday, which turned out to be unnecessary because the government obviously stepped in. So it was probably one of the craziest experiences of my professional life. But, nonetheless, I think most customers were okay.
So you had a huge surge in demand all at once, really, around that. But we've seen, kind of the issues within the banking sector grow quiet recently. What about demand now? What are you doing to attract other business customers to you all?
Absolutely. So we found that, that spike in demand happened around then, but it's been a lot of new demand has been coming because we've seen a change in behavior from customers from wanting to have one banking partner to having multiple banking partners. So before we saw, hey, I want to have my relationship with SVB and concentrate there. Now, we feel that customers have an account with Brex for their day-to-day needs, but they also have an account with JP Morgan or one of the big 5 banks. So we're seeing this kind of distribution of having multiple banking partners and using each of them for what's their best. Brex is really good because it's really easy, simple, online. So it's great for your day-to-day needs because it has a lot of the software that's integrated all into one place.
Let me ask you, how does artificial intelligence wrap into your products? I know in a lot of your fintech firm, I'm assuming it probably pervades your organization, but could you just go over some of the things that a consumer who's used to maybe consumer-facing AI might not expect that is powering your company?
Absolutely. A great example for Brex is around doing your expenses. So we replace traditional companies like SAP Concur for expense management and travel. Today, that's the core of our business, is replacing American Express for corporate cards and SAP Concur for expense and travel. And we use a lot of AI, so you don't have to do your expenses anymore. You can just swipe your card and that's it. No more tracking receipts, uploading memos, calendars, none of that. You just swipe and that's done.
Oh my gosh. I mean, I literally was going to ask you how you're reducing friction when it comes to that, because I hate doing expenses. Like you're taking a picture. I mean, it's easier than back in the day where you had to kind of tape receipts on everything. And, now you can take a screenshot. So what is it, like, how are you all pushing this forward, this, kind of technological advances and innovation when it comes to reducing friction, whether it's expenses? And I'm assuming some companies run payroll through you all as well?
So a lot of companies run payroll through our Brex business accounts, which is a banking replacement. So coming out of our accounts, to the employees, but we don't do the payroll software ourselves. But we do, again, a lot of the expense reimbursements, expense tracking, travel, and we basically removed all the friction from that. So, a few years from now, we believe you're going to look back and you're going to think that taking pictures of receipts and having to manually type stuff in is as archaic as the tapes you were describing. That you're just going to like Apple Pay or swipe your Brex card and that's it. Nothing else needed.
I do look forward to a future like that. We have about a minute to go. I'm going to give you the floor. Anything we didn't cover or surprising that happened with regard to the panic we saw earlier in this year? Anything you'd like to tell us about that might be surprising?
I would say the only surprising thing is that, it was how long it took between when it happened and all the rollouts, and the acquisition and everything. I think there was a lot of moment of panic there. But I do think that after it happened, the market is evolving to even safer, more secure. I think we're going to be in a better place.
And before you go on, Enrique, I don't want to lose you without asking this question. I mean, you all are doing really well. You've been going gangbusters as a result of that SVB collapse. Any IPO plans in the future or near future, especially?
Well, nothing in the near future. I guess, even though Brex is a big company, we raised over $1.5 billion in equity at $12 billion valuation. We're only 6 years old, so we still have some time to go. And I would say we're going to wait for the markets to get a little bit better.
All right. Brex co-CEO Enrique Dubugras, thank you so much.
Thank you.
Coming up, generative AI is getting a lot of hype for the impact it's expected to make in tech. But what about other industries? More on that when Yahoo Finance returns. Generative AI is getting a lot of hype for the impact it is expected to make in tech, with companies like Google, Microsoft, and Nvidia being propped up as leaders in the revolution. But what about other industries? Marco Argenti, Goldman Sachs Chief Information Officer, joined Yahoo Finance this morning to discuss a path for this new technology in one of the leading global investment banks. Take a listen.
It's probably one of the biggest revolutions or changes that I've ever seen. And I guess you might decide whether to buy into the hype or not, but definitely we see that it could lead to profound changes. And we are a fully digital business. We're all about people and we're all about data. We don't have physical operations, etc. And I think those will be the segments and the industries that are going to be disrupted first by AI, because first and foremost, AI is a disruption of knowledge. It's a disruption on the way we actually do business that is knowledge-based. And it really bases itself on the quality of data and the ability to kind of interpret the data in ways that, let's say, humans are kind of not capable of doing. So we believe that AI could be a profound disruptor, not only of our industry, but all digital and all information and knowledge industries in general.
So what's the biggest opportunity when it comes to generative AI for Goldman Sachs specifically?
The first consideration is that you have to think of AI as both a sustaining and a disruptive technology. Sustaining in the sense that it might lead to productivity gains higher than probably what we've ever seen. But I think I always warn people and CEOs and boards that I talk to that only focusing on the sustaining on the productivity side is not enough if this is indeed a disruptive technology. And so finding that right balance, I think, is absolutely crucial. So on the productivity side, one of the very first targets, and this is kind of where we started, is how to make the technologists and the developers more productive. Why that it could be a good start? Well, because AI has proved to be particularly effective in generating, commenting, and helping you get a better quality code. Because the vocabulary of computers is actually more limited than the vocabulary of humans. And so if you think about it, in that kind of a restricted environment, AIs really perform at their best. But then you kind of walk your way through other non-developer, non-technical workers. And so the next being the knowledge workers that can be disrupted, people that are working in producing content, producing pitch books, or even summarizing large forms or large quantities of data, like earning reports or public filings. We're working on making that much more automatic, much more effective, and really trying to, at the end, in a way, make people kind of having a sort of a co-pilot with them. It's kind of a little bit of an abused term or overused term, if you will, but someone that could actually bring the right information to you at the right time.
I mean, it's interesting what you said about vocabulary. I mean, that makes me think of it as almost a translator between a human and a computer, that the generative AI sort of sits between and helps bridge that gap in a way.
Absolutely.
So where are you inside Goldman Sachs in this process, right, of incorporating some of these new technologies? And what is your process? I know you have a big engineering staff.
Yeah. We definitely have a pretty sizable engineering staff, and we're really looking forward to technologists really to be in the driver's seat to kind of lead this revolution of AI. In terms of where we are, right now we're conducting a number of what we call proof of concepts, and in some cases those are actually starting to be expanded and extended to quite a bit of people within the firm. The first one being the developer productivity, as I mentioned, but we're also working, for example, on the summarization of large quantities of data into the hands of the people that consume that data every day. So we've enabled, let's say, natural language queries interfaces where people can ask really complex questions, such as, given the earnings of this company, give me all the companies that might be impacted by this particular things that was reported, or for example by a hypothesis that exchange rates might go in a certain direction. So you kind of state your hypothesis, and then the AI will bring information to you that really connect the dots and really summarizes it in something actionable. I think this is really the power of AI, which is it has an uncanny ability to fill the blanks. For example, if you have incomplete information, it can really effectively fill the blanks and actually give you a sort of a good trajectory. It's like the next level of sort of interpolation. And then the second part is really connecting the dots. You can ask very complex questions that span multiple elements, multiple factors. It could be macro factors, micro factor, your own research, your own data. And this comes into a hypothesis, comes into something that really connects those dots in a way that is almost like is very human, but in a way is superhuman because it processes this incredible amounts of information. And then, this summarization, it can give you, like imagine, for example, a banker wakes up, gets an email that says from an AI and says, this just happened in the world. This might impact the following clients. These are the 3 talking points that you should tell them. And it's a very pointed, very...
And how far away are we from that?
I think we're actually not that far away from that. And right now the challenge is really, and for us it's been a big focus, is how to make it safe in the sense that the information is actually correct and accurate, because AIs started as a very plausible answer engine. It gives you things that sounds really, really good, but then sometimes they turn out to be incorrect. And so we've done a lot of work to really make sure that you merge the ability to kind of produce content with the ability to actually retrieve content and then cross-check it and make sure that it's correct. And so that is, a very important part. And I think, the state of the art is moving really, really fast. And so I think we're getting, very close to have something that, is nothing short than a revolution.
Marco, you sound like a tech guy, not a finance guy, because you are a tech guy, right? You came from Amazon Web Services before. And making that transition from native tech to finance, talk to me about the difference between them and how good does big finance need to be at tech? And how does the firm think about it versus an actual tech firm?
Well, see, when I was at Amazon, I was working on digital transformation on some of the large industrial companies in the world, and especially I work a lot with automotive manufacturers. And that made me realize that software is actually becoming the key component of every industry. Think about the evolution of a car that goes from being a mechanical thing to almost being, like right now, a data center on wheels. And that is really happening in every segment. And so I think the big difference today is the fact that technology is no longer the back office IT organization. Technology is actually the driver of a lot of competitive advantage and actually is the driver of the strategic agenda of the firm in many cases. And so I think the evolution here has been technologists have a seat at the table when it comes to strategic directions. And one of the cultural changes that we've been trying to apply at Goldman is the idea of, for developers, which is theoretically a little bit unnatural, to go from focusing on the how to actually focusing on the why. We call it working backwards from the customer, really understanding really understanding what problems you're trying to solve, really understanding who is your customer, and then from that being able to articulate it together with the business owners and then turn it into a solution. And that reversal of priority from how first to why first, I think is something that really characterizes the new role of the engineer. Engineers' roles have changed, and today is kind of a mix between data science, traditional development, and business that come together in this powerful combination that I think really drives the strategic agenda of any firm.
I do want to ask you sort of some bigger picture questions about the business. There is a report today in the FT about Goldman potentially exiting an investment in advisory business, which I know is not your purview. But I would ask, as Goldman sort of tries to make some transformations, how you see your role in assisting in that sort of restructuring or pivoting of the business.
Yeah, so of course, there is a lot of technology involved in everything that we do. I think one of the observations that maybe I can share with you is the fact that the importance of data is central for us to make decisions, but also for us to course correct any decision. And I think really a really big investment and a little big focus that we had in the past few years is really to create an infrastructure within the firm that allows data to flow freely in a way, and also to be summarized and to be consumed by business owners in a way that actually allows us to make decisions that are faster and potentially more accurate than before. And so as you kind of navigate a world that is changing at a pace that we've probably never seen, where you have what we call like the tail events that are becoming more and more frequent, I think the role of technology is to kind of make sure that people that are the ultimate business decision makers have the right data in order to make those decisions in a very informed way, I think is absolutely central, especially in a time of change.
Speaking of a time of change, I would be remiss if I didn't ask about some of the noise surrounding the firm right now and the leadership of the firm, as someone who is a leader at the firm. What can you tell us sort of about the vibe inside Goldman right now, the feeling inside Goldman, and how you are leading your people right now?
Well, we have no shortage of things to do. We're in the middle of an AI revolution. I think we really keep a steady course. We think our strategy is very solid, and we have an absolute focus on the business right now. So the focus on the business and the focus on our strategy is kind of the noise filter. So we kind of leave the noise outside in a way.
All right, our thanks to Marco Argenti, Goldman Sachs Chief Information Officer, as well as Yahoo Finance's own Julie Hyman.
And shares of Zoom, they're trading up almost 5% after reporting second quarter earnings, stock popping as the company raises its profit and sales forecast for the year. So this is a good sign for the company as it looks to expand its products beyond its video conferencing software. Diane, just looking at some of the numbers here and just focusing on the guidance, they upped it a little bit, just fractionally to $4.49 billion to $4.50 billion, beat the estimate fractionally, but it's EPS where the profits where their guidance is really strong. 463 to 467. Previously saw 425 to 431. The estimate was way down there at 432. So nice beat there and a raise. So your thoughts on this?
Yeah, I mean, it is. It's better than expected, because one of the things that people started to question is, had Zoom kind of lost some of its steam, especially when you think about even the announcement that they made recently about calling employees back into the office.
Yes.
I mean, it's Zoom.
There's a certain amount of irony there.
Yes,
it smacks you on the forehead.
Exactly.
Okay, yes.
And now they want, staff back in the office, this month through September, at least on a part-time basis. So yeah, it's very ironic. So it's like, is Zoom what it says it is anymore? And if they're doing that, what does that mean in terms of the company, how are they doing financially? So certainly, definitely a good sign for them in terms of them beating. But, even when you look at the stock and compare to where it was once upon a time, I mean, it's it's up today, but it's down huge once its high was around 400 something.
That's what it says there on the screen. I'm looking at here. If I go to the Wi-Fi Interactive, I can pull up the 2020 high right near $600 a share.
I didn't even realize
and by the way, the price right now, I think the opening day price was about $60, $62, something in there. So it's been hovering right around those lows, and you can see as just asymptotically approaching that initial IPO price. It looks like a lot of pandemic charts here, but
it does.
It does. There's not a lot to say beyond that.
Yeah.
So, coming up, we're going to head to the other side of the street and check in on some of the top trending stories of the day, including one grocery store and how it became the country's biggest sushi seller. You're going to be surprised by this.
Good morning. This is Yahoo Finance.
Big news, 3 things that you need to know.
We just got the announcement.
What happens now?
I got a question.
What does success look like?
What was one of the biggest challenges that you faced?
How much does that raise the odds for a recession?
This phase is over. Tell me what happens to the debt ceiling.
Where does generative AI, though, fit into your portfolio?
Talk to us about this diversification and what investors need to know.
And I think it's important. This is the stuff that gets me out of bed, fired up.
What's the gateway? What's the new bridge to opportunity?
Doesn't matter if it's a soft landing or a hard landing.
Big interview. I can't wait.
Supreme Court out with the ruling on President Biden's student debt cancellation.
Right, let's turn now to some recent tech earnings, and they give you information if you watch them closely.
President Bostic, President Investor Gary Gensler, thank you so much.
Part of what Davos is about is sharing best practices, coming forward with ideas, and then enabling those ideas into action.
And I would add that there's more to come on this.
And we keep producing products that help people lead healthier lives.
This is one of those rooms they use to simulate light in space.
Interest rates will come down again.
Figure out where your money is going now. You gotta scope that out.
And the numbers really tell the story.
What does all this mean for you?
Keep it tuned into Yahoo Finance.
Welcome back to Yahoo Finance Live. I'm Alexandra Ganell, joined by Josh Schaefer and Diane King Hall. We got a lot of stories today. I want to talk with Sweetgreen, one of my favorite go-to lunch spots here in the city. Interestingly, they are hiring 2 former Chipotle executives. And guys, it seems like when we talk about these fast casual restaurants, they're all trying to emulate Chipotle. And as you can see there, we have 2 executives leading the marketing side of the business as well as the culinary side. Sweetgreen's really trying to expand their footprint beyond these major cities on the East Coast and the West Coast, go more Midland, and they want to establish a really strong brand identity and have new and unique options. But, you know, I think about the Chipotle share price, how much higher that is compared to a Sweetgreen or even Cava.
But Sweetgreen has done well in terms of its share price year to date. I mean, it was actually up double digits, or is that the year-to-date chart? No, that's a 5-day chart we're looking at right now.
But still, look at it.
5-day chart, it's
almost
up
2,000.
It's up about 5%, but on a year-to-date,
I know, but still,
on a year-to-date, but clearly this is a push for Middle America. We've talked about this with, say, like Cava. I'm originally from the Midwest, although I've lived here a long time. I won't say how long. You know, and it'll be interesting to see if this works. You can see why Chipotle works. It has the drive-through lanes. Will Sweetgreen can't do that here.
To me, it's the menu innovation that they're talking about, right, in that report, because that's what Sweetgreen, to me, even being in New York City where you see a lot more Sweetgreens and you in theory see more Sweetgreen advertising, they haven't come across to me with the new adobo chicken that's at Sweetgreen, right? Your friends aren't talking about things like that they talk about at Chipotle. The new brisket, the smoked brisket, right? Chipotle's
so you're saying you have more innovative
tying the marketing with the new menu items is something Chipotle's been very successful at. A lot of fast food chains are very successful at, and I don't think Sweetgreen has quite achieved that yet.
How much innovation can you do with a salad?
You probably make it less healthy, right?
Very innovative salads. I'm the go-to salad maker in my family, and you can get creative with it, but you know you need to present people with those options. As you
seasonality push. What's your pumpkin play, right?
They do that,
right? And they have like a fall harvest bowl and stuff that they'll come out with. But how do you put it in front of the consumer and really make it feel new and different? I don't think Sweetgreen has quite gotten there yet in terms of marketing in the way that a Chipotle does. And so that's what I think is interesting when you bring in some of those executives.
I think Sweetgreen needs to just play to its strengths, which is the organic, farm to table, the healthy kind of vibe. Because even at Chipotle, sure, you can make it healthy, but you also don't know where they're getting their ingredients. If I'm going the healthy option,
where's Sweetgreen getting their ingredients? We don't know where Sweetgreen's getting their ingredients
either. It's on a little board. It says the farm that they bring it, that they get it from. So you can see where it's from. And honestly, if I'm going healthy, I'm picking Sweetgreen over Chipotle.
Did you do Sweetgreen for lunch today?
I didn't do Sweetgreen for lunch today, but I do it most of the time if I have to go out there and get something to eat, I will say.
All right. Sweetgreen is a little expensive, though, a little bit on the expensive side.
It's like $17 for a salad,
Mine is like over 20.
It's more than that. I knew it.
I had a lot of stuff.
And so that's probably why workers want to be making more money, right? So the story I was looking at today that I'm going to transition to now was a survey out of the New York Fed on how much workers are looking for when they're going to change jobs. So workers now demanding $78,000. That's up 8% from last year. And another stat that I want to point to when discussing that I think is important is so up 8% from last year, that's notably higher than inflation, right? This is one of the conversations that people are starting to have now when we talk about wages, and we're interested in how wages are significantly higher or staying higher than the rising rate of inflation, and sort of what that means for the last leg of inflation and for it to come down. You take a look at wages right now, up about 4.4% according to the BLS, and that's above an inflation number that's increasing at 3%. So you're seeing people still making more money than inflation is rising. How does that impact sort of this last leg of people being willing to pay higher prices? They're probably still going to be willing to pay higher prices.
And to your point, though, about Fed Chair Jerome Powell has talked about that before and did not want to peg all of the issues with inflation, the rise in inflation that we've seen to wages, because he said he felt like, you know, of course you don't want to take away from the healthiness of where wages are. But it was interesting to see that this is the number now. It's more than $78,000 a year. You can see obviously why in certain cities that would be important, because the cost of living is so high, like on the coast, right? Whether you're talking about New York or in California, this is not going to cut it. And we're looking at that, the average annual full-time salary, just topping $69,000. So the fact that people are looking for an increase from what the average is, they're like, we want more, right?
And there's still a lot of strength in the labor market, and the employee has the upper hand here, and you do wonder how that factors in to the Federal Reserve's interest rate decision. We have one more labor report right before Labor Day weekend that will hopefully get a better picture of where things stand. But yeah, certainly, I mean, if over half my salary is going towards things like rent, for example, which has been very sticky.
Often here is the case, 50%.
Which is often the case. Of course, I want my salary to be significantly above that inflation rate. And you hear those types of conversations all the time. You know, oh, my salary didn't go up this year to account for inflation, and that does factor into a lot of your
one thing that stood out to me in this report from the Federal Reserve Bank of New York was that even though there is this desire for a certain level of income, the expectations for receiving an offer in the next several months is it declined, you know. So, and then there were just the expectations of losing their job that actually increased compared to a year ago. So it's interesting to see that though there's a difference, a divergence in the expectation for what we want and what we think is going to happen.
Right, exactly, right. And then this is not exactly the hard data that shows what will happen either, right? This is just simply the expectations, as you said, for what people do want, which is why we'll keep watching numbers like that wage growth number, which is backward looking, but it's interesting to look at that because that's real wages. You're looking at what is actually happening to people's income. And I think as long as people's income continue to be increasing at the level that it is going to be interesting to see what happens to that consumer spending, because right now it seems like people still have a little bit of money.
I don't have a natural segue to the next story that we're watching, but this is something that kind of goes back to the story of food.
Yes.
You know, we talked earlier about food. This is the story that caught my eye today. Kroger has apparently become the biggest seller of sushi in the U.S. I saw this in the Journal. Apparently, they sell more than 40 million pieces of sushi in a year. I have been guilty of buying grocery store sushi before, not often, but I've bought it once before. So it's a thing across the country. It's happening. You're seeing just numbers rise across the country. Volume of sushi sales up more than 50%, or about 50% over the past year. Sales up 72%. Have you guys bought sushi at the grocery store before? You guys are looking with judgy eyes.
No. I see it at the grocery store. I don't. That's not something
I'm not a huge big sushi person.
I am.
But I have bought Wegmans sushi.
Yes.
I do enjoy Wegmans sushi.
Yes.
I am excited for the Wegmans that's coming to Manhattan, and I will be eating
right underneath our office.
And I will be eating some of that sushi for sure. I think it's a great way for grocery stores to just get another round of revenue, right? Get another diversification to their business, because when you look at the fact that people walking through the store, I am not necessarily always sushi, but I am definitely a sucker for the fresh food.
Yeah.
Like when you walk by that section, especially if you go the day of, I've said multiple times, I go to the grocery store a lot. So when I go to the grocery store, you often get those day of deals where the food might be going bad the next day, so you get it discounted. That happens with some of the sushi, which is nice.
Don't buy sushi that's going bad.
No, it might go bad the next day though, and so you eat it for dinner that night.
Oh, maybe. Since
Half
you
off.
are, since you
Half
cook,
off. I did
Josh
it-
does cook.
I did it
so
with chicken
we'll let
last
the people
night.
know.
There was fresh cooked chicken, and they said it was, instead of $8.99, it went down to literally $3
Okay.
because it was going to go bad if
The
you didn't eat
next
it.
day?
Yeah, it was going to go bad
How's
today.
your stomach
So I
today?
had it for dinner last night. I feel great.
Well, going back to the conversation.
And I
that
don't
we even-
really
Yes.
quickly. I don't buy sushi all the time because I saw the judgy
Dan,
eyes. just
I don't
once in the
judge.
grocery
I don't judge
store.
anything that people eat. I mean, because I eat a heck of a lot. Like I said, my Sweetgreen salad is like $25,
Yes.
so no judgment here.
Thank you.
But I will say that going back to conversations that we have had before on how consumers are buying dinners, like full-blown
Right.
dinners at the grocery store, versus going out to dinner because the grocery store prices are coming down at a quicker rate.
Yeah.
This just feeds into that narrative as
Oh, it
well,
totally
because
does.
you could get a thing of sushi. That's your dinner. You don't need anything else
Well,
besides
and it
that.
eliminates the other thing we've talked about too, which is the awkward tipping scenario, right?
You
when you
don't
pick
have
up
to tip the
food,
grocery
if you're someone that
store
gets
for the
worried about
sushi.
that, you're
Yeah.
not tipping
And
when
the
you pick up a full
fees-
meal at the grocery
yeah,
store,
true,
right?
true.
You just pay your
That's the
$12,
argument.
you move on.
Over DoorDash, which I do love. I do love my DoorDash too. So. No judgment, Diane.
It's okay. No judgment there. Judgment-free zone.
Exactly.
Coming up, it is closing time here on Yahoo Finance. We recap the top stories of the day. Get you set for tomorrow. Stay with us.
Finance's week-long retail special, we found out about the state of retail. But what does the everyday consumer think about it? Let's go find out. Have you noticed rising inflation impacting your spending at all? Are you spending less anywhere?
I'm definitely spending less everywhere.
I'm working, I'm making overtime, so my liquidity is a little bit more, so I'm spending a little bit more.
I'm definitely saving as much as I can everywhere and anywhere.
My dollar doesn't go as far as it used to.
I thought I would wait a month after I started school to get a job, but now I'm going to get a job in like a week because I can't really pay for anything.
Are you spending less anywhere that you used to spend more and opting out of certain purchases?
As far as food purchases go, I'm looking to spend a little bit less. I'm not spending as much money on, the frills, clothes, makeup, the fun stuff.
Clothing, I mean, you always look for the sales prices.
Eating out, probably going out with friends.
Where do you feel like you're spending a lot of your money?
Probably clothes. New York City street fashion is intimidating, so I gotta keep up.
I like cooking, so like vegetables mostly. I think they're kind of expensive.
On hair products.
Gasoline, because I drive at home. Alcohol is probably right below gas.
Are you an online shopper or someone that likes to go in the store? I a lot more online. The convenience.
I would rather do it in person, but sometimes it's just easier and cheaper to do it online.
In person, so that I can try it on.
Online. I hate going to the mall.
I really much prefer in person. I was speaking with the shop owner yesterday, and he said, youngsters don't buy these kind of boho clothes, and if they do, they get it on Amazon. Everything is becoming more bottlenecked towards the internet, so you're having a lot less choices. Amazon, it's pretty much the way we're going now.
It is closing time here at Yahoo Finance, and here's a look at some of the top stories and trending tickers of the day. SoftBank's ARM Holdings officially filing for its initial public offering, and it is set to be the largest IPO of the year. The chipmaker disclosing key details about its finances, including total revenue for the fiscal year ending in March, which was about $2.68 billion. But it did not detail proposed terms of the deal. Stock will be listed on the Nasdaq under the ticker ARM. And American Airlines pilots agreeing on a new labor contract, which includes a 21% pay raise. Compensation will rise another 46% over the duration of the 4-year contract. The agreement also includes improvements in scheduling and benefits. American is the second carrier to reach a deal with its pilots following United. SentinelOne shares, they are jumping more than 16% on the day. Reuters reporting the cybersecurity company has been exploring options for itself, including a sale. It's become a takeover target as the stock has lost 80% of its value in the last 2 years. And in its latest earnings report, SentinelOne slashed its guidance for annual revenue growth and said it would lay off about 5% of its employees.
Time now for what to watch tomorrow. A slew of earnings on tap for Tuesday. We'll hear more about the state of the consumer. An interesting data point here of the retail companies have already reported 79% of announced profit beats, according to the London Stock Exchange Group. Tomorrow we'll get results from Macy's, Lowe's, Urban Outfitters, and Dick's Sporting Goods. Apart from earnings, we're looking at some housing data. Existing home sales out tomorrow. The street is forecasting a seasonally adjusted rate of 4.15 million units in July. That's nearly in line with June's numbers. And finally, it's a big week for the Fed. We'll hear from a number of officials Tuesday in advance of the Fed's big economic summit at Jackson Hole later this week. Tom Barkin, Austin Goolsbee, and Michelle Bowman all expected to speak at different events on Tuesday. The street is waiting for any hints about where rates are heading and the state of the economy. That'll do it for today's Yahoo Finance Live. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell.